Hello everyone, I hope you can all hear me. Sorry for the slight delay. I was trying to use a slightly superior source of audio, which clearly has been a failed attempt by me. So I hope you can nevertheless hear me loud and clear. What I'm going to show you is I'm going to take you through a presentation which I prepared earlier today. What I tend to do each month towards the start of the subsequent month, so the end of March in this case, is I look to create a trading plan for myself for the month ahead. And that's what I'm going to cover here. I'm going to cover a plan that I created just today for this subsequent month ahead. In that, what I want to do is take you through what I tend to look at for a given trading month, which in this case is going to cover commodities, going to cover UK stocks, US stocks, and it's going to cover foreign exchange as well. So what I tend to do is keep this by my side every month at the start of that given month, and then look to use it as a guide. Also, when I'm doing various TV appearances and the like, it's very useful for that as well, because it allows me to get a coherent and well-analyzed form well in time, well in advance of the broadcast and so on, and hopefully makes me sound somewhat knowledgeable rather than ad hoc or last minute. So that's the background to what I'm looking to achieve today, and I hope that you're going to find it very useful. First of all, as I said, I'm going to cover UK, US, India, China. I'm going to cover spread betting, CFDs, ETFs, all of these kinds of things. But what that also means is that I've got to also give you some warnings, and you'll see why I've called it the best of the best in a second. It's partly because of some of the stock picks. The content in here is exclusive to me. It's taken from a variety of sources as well as my own analysis. It's relatively simple, and the reason for the simplicity is I want to cut right to the chase of what I think should be traded and what shouldn't. It's actionable. The idea with this monthly overview is that anybody should be able to action upon it. Obviously, expertise, global, accurate, I expect as well. What can be leveraged, and there's risks associated with that. Equally, I don't know any of the individuals online personally, so it's not personal financial advice. This is more journalism, it's advice in terms of my opinions, not specific advice to any individual, and you should, as best practice, always stick useful financial. So let me kick off. First of all, let me let you know that a whole schedule of webinars will be up on alpeshpatel.com and /webinars, and I will on there go through a variety of issues like trading strategies, who makes money trading, and so on. I'm going to aim to do about one a week because my schedule will permit that. Now, let's start then. Bit of comment and analysis. Yes, despite what you see there, I am not the next president of the World Bank. Thank you, BBC, for the endorsement. Very kind of you. As you can see, I'm gobsmacked at the thought. But don't worry about reading all of this on here. They're more note myself with this. And the Wilshire 5000 takes account of, as you can see, obviously 5,000 stocks, but across all capitalizations from large to small. So it's a very broad measure. We are at an all-time high when we take into account total return. The first point I want to make, I want to start off with a top-down view. I want to start off with a macro overview, which will then be used as a basis for some specific stock ideas and actual names and time periods and what I like. Not just stocks, but commodities, what I think about oil and gold, what I think about foreign exchange currencies. But first of all, I want to mention this. We are at an all-time high. It doesn't feel like it. Some people have problems believing it. But we are at an all-time high, and we've pretty much doubled since the bottom of the crash, the point at which the old saying, I think it was Warren Buffett saying, buy when others are fearful and sell when others are greedy. Well, I don't think people are getting greedy at the moment because I don't think many of them realize we're at an all-time high, but we are. Now, that sets an important context. Doesn't necessarily mean we should immediately buy. The one thing you should be aware of is that the S&P 500 traded at just 14 times earnings. In other words, the PE multiple, the price-earnings multiple, a measure of valuation, the lower that multiple is, the lower 14.1 or that figure is, the cheaper it is. Well, it traded at 14.1 times earnings when the market hit its most recent high on March the 1st. That's the lowest valuation of any 52-week market high going back to 1989. So if you take any rolling 52-week market high, so any time the market's been the highest over any rolling 52-week period, this is the cheapest valuation it's ever had when it's been at a high. You would expect when the price is at a high for 52 weeks that the security would be expensive because obviously price earnings. Price would be high, we already discussed. But what this means at 14.1 times earnings is it's relatively cheap. In other words, earnings are cheap because it's price over earnings. And whilst the price is high, if earnings are also high, then what that essentially means is PE can be low. And in fact, that's exactly what's happened. That means valuation is low. And when the valuation is low, it also means P can go higher without it all being expensive. So that's definitely good news for those who are biased towards the equity markets. And I'm a believer that the markets will be going up this year. In actual fact, if you look at the bottom on forward PEs, those are the predictions for the major economies, US, Japan, Brazil, China, India, Russia, Europe. And I'll mention some of the stocks which I, as well as some of the research from the big investment banks, believe are the best purchases in these areas. You can see that these two are relatively low compared to 2008, or the peak of the market when credit crunch happened, which was around February 2008 is when it happened. You can see that in actual fact, virtually all of these are below the high of that period. And that's positive because what that, in a way, is telling us is that we're relatively cheap at the moment. Cheap because earnings are high. Earnings are high. That is then leading into consumer confidence. This is from Bloomberg. The orange line is the world index, and you can see a moving average of the world index, and you can see consumer confidence. Now, you don't need to interpret this. Let me just tell you what it's essentially saying. It's saying that as equities have gone up, consumer confidence has risen. Retail stocks, which most people wouldn't be looking at the moment, are starting to, and this is an early indicator, a lead indicator, are starting to have something of a positive rise. Now, you might turn around and say, yeah, Alpesh, well, that's all well and good, but what about debt? What about corporate debt? Well, net debt of companies in the US compared to earnings, EBITDA is a measure of earnings, consider it profit. So debt to profit is roughly around 5 to 1. What that means is there's $5 of debt for every dollar of profit. That's the cheapest it's been, or the least leveraged, the least amount of debt to profitability for the last 10 years. Companies, American companies, are not debt-ridden. They've paid down their debt. They've become more productive after the crisis. They've made people redundant. So they've paid down debt and borrowings and are making more earnings for every dollar of borrowing. So for every $5 of borrowing, they're making $1 of profit. What does that mean? Well, it means that I'm not worried about the level of debt. I'm not worried about the valuation of corporations. Are there any other reasons, any other things I should be worried about? Well, of course, if you look at total debt of countries, non-financial, financial, government, and households, absolutely. Of course, some countries like the United Kingdom, here's a chart you don't see very often, G10, 900% of GDP is UK debt, vast majority of which, as you can see, is financial debt. I'm certainly not worried about US, that's for sure, because they've got less debt than Switzerland or Norway and even Europe. So I'm not worried about anything on here other than possibly Japan and the UK. Well, Japan's been surviving for a long time. The United Kingdom might be a bit of a worry, and therefore we're going to have to take a bit of a bottom-up approach and look at specific stocks which are benefiting.